Chapter 3. Behavioral Obstacles to Value Investing. In this chapter, Mr. Parikh discusses about 1. Behavioral finance, 2. Asset allocation and risk aversion, 3. Investment styles, 4. Returns, 5. Conclusion. Section 3.1, Behavioral Finance. Mr. Parikh says that behavioral finance combines psychology with financial decision-making processes. It challenges the traditional economic theory of efficient markets and rational decision-making. Mr. Parikh asserts that markets consist of humans and humans act on emotions. These behavioral anomalies from market participants lead to irrational behavior in financial markets. Investors often make mistakes, such as selling winners too soon and holding on to losers, buying expensive stocks, and following the crowd, and these kind of investors get bad results. Successful investors are the ones who combine sound intellect with emotional discipline. Section 3.2, Asset allocation and risk aversion. According to Mr. Parikh, asset allocation is a critical step before making investment choices. Understanding the risk-reward ratio is essential for designing an asset allocation strategy. Many investors tend to be risk-averse and overexpose themselves to bonds, whereas equities have historically outperformed fixed-income securities. Mr. Parikh further discusses the concept of financial planning and says that the financial planners are the process followed is often a fixed pattern, but it's important to consider individual needs and financial positions. Many money managers and financial planners are reluctant to invest in equities due to risk aversion. However, bonds can become risky in an inflationary environment because bonds tend to give negative or very low inflation-adjusted returns during inflationary periods, whereas wisely chosen equities can be a safe haven during the same time. Section 3.3, Investment Styles. Mr. Parikh says that most money managers are categorized as either value managers or growth managers. Mr. Parikh further says that very few managers take the time to analyze fundamental characteristics of portfolios that produce long-term market-beating results. This is because value investing requires a lot of hard work, patience, and discipline, which is not everyone's cup of tea. Some money managers get swayed by market trends, preferring quick gains over value investing. Herd behavior often drives stock prices for growth stocks, and very frequently the stock prices run ahead of fundamentals. Section 3.3.1 Process versus Outcome. Mr. Parikh further discusses the concept of process versus outcome. Mr. Parikh emphasizes that the right process followed over and over again is bound to ultimately produce the desired results. However, people tend to follow the outcome rather than the process, leading to poor investment choices. In this section, Mr. Parikh discusses some behavioral mistakes that many investors make. Loss aversion causes investors to hold on to losing stocks and sell winners too soon. Many investors tend to prefer novelty over familiarity of the proven, tried and tested traditional wisdom, which is proven to generate results over long term. Immediate gratification is preferred over patience. Explaining the popularity of momentum investment strategies. Value investing involves buying businesses when they are undervalued based on fundamentals. Mr. Parikh says that stock markets reflect the sentiments of the investors. When the sentiments are bullish, the expectations are high, and when the sentiments are bearish, the expectations run low. Understanding these expectations and assessing their impact on the price is the key to good stock picking. Mr. Parikh says that the process of valuation of a share of a company is a challenging task, and it requires predicting future cash flows and understanding the business and the environment. According to Mr. Parikh, discounted cash flow method is the right way to value a share, but this is challenging and not everyone is willing to put in the effort to understand the business, the industry, and make fair estimates of expected future cash flows. Mr. Parikh further says that valuation heuristics, such as price to earnings, price to book value and price to sales ratios, if used in isolation, will give inaccurate and incomplete information, and will lead to cognitive biases and ultimately poor investment decisions. Section 3.3.2. Growth Investing. Mr. Parikh further discusses growth investing. Growth investing is about buying what is currently popular. During bull markets, stocks that are in favor, like internet retailing stocks during the technology boom, become expensive and run ahead of fair valuations and hence are better avoided by intelligent investors. When stocks which were value stocks catch the fancy of the market and become overowned, these stocks run ahead of fair value and are started being regarded as growth or momentum stocks. In bull markets, some stocks, like financial services firms, are chased as growth stocks and bought even at very high valuations in the hope that future earnings will be no less than stellar. However, the sustainability of competitive advantage is a crucial question. Mr. Parikh says there is nothing inherently wrong with owning overvalued stocks in the hope of great future earnings growth, except that one has accepted promises of returns for one's money, and in the business world, future promises are easily made but take great effort to be met with. Section 3.3.3 Growth Stocks and Behavioral Traits. The term growth stock is somewhat meaningless since it can only be identified in hindsight. Growth stocks are often more like dream stocks. Herd behavior makes many investors join the bandwagon. Availability heuristic influences investors to follow growth stocks. Investors tend to chase fads and fancies in the market. Stock prices reflect expectations, and anticipating expectation revisions is crucial. Understanding expectations and their impact on prices is essential for good stock picking. At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel. Section 3.4 Returns. Investing aims to earn a return. Value stocks are similar to 5-day test matches, while growth stocks are like 20/20 matches, and investors often make the mistake of equating speculative profits with returns. To illustrate his point, Mr. Parikh quotes the example of Reliance Natural Resources Limited, which at one point was quoting at a P/E ratio of 600 times, and still some of the most reputed professional mutual funds that talk about long-term value investing had also bought RNRL at absurdly high valuations. Section 3.4.1 What constitutes stock returns? Mr. Parikh reiterates that stock returns consist of dividends and capital appreciation, both influenced by the acquisition price. Buying stocks without considering their value and the price paid can hurt long-term returns. Stock returns grow over time, emphasizing the importance of patience and discipline. Section 3.4.2 Growth is not returns. Mr. Parikh says that investors often mistakenly believe that higher sales growth leads to higher returns on capital employed and higher profits, however that is not the reality. Sales growth is only valuable if a company earns returns on capital employed which is higher than its cost of capital. Section 3.5 Conclusion. Despite evidence that value investing is safe and delivers results in the long run, many investors and professionals don't embrace value investing strategies. Resistance to change, fear of failure, greed, and envy are reasons people get trapped in the growth trap. Value investing, a contrarian approach, is based on understanding one's emotional and psychological weaknesses, benefiting from others' mistakes, and having the conviction to stand apart from the crowd. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you.